How you doing, friends? Got a question. What is more important to people in today's world? Is it the nature of the origin of the universe or the answers that lie out there beyond? Or is it a popular sitcom show that is now canceled, but in syndication around the globe? You get it. You're right. It's the sitcom. The name of this episode, number 22 of the Zero DTE podcast, is The Big Bang Theory. Is volatility back? Has it returned? And it looks like it has. This is a welcome sight. I'll tell you, when volatility is low, it makes analysis of the market extremely difficult. And there are a number of reasons. First of all, really, you need to trade less. And that's because the signals aren't as sharp, they're not as strong, they're not as clear. Volatility is down, liquidity is down, volume is down, everything is down. Now, while some people think that there's actually more security, more predictability in a market that doesn't move much, that couldn't be further from the truth. It is far more difficult to pick a direction. It is much easier when the market has momentum and it's really got some strength behind it. It's moving up, it's moving down. Now, it's really in the short term, by the way. This is not something that you can extend out to a long period of time. Between 17 and 34, the VIX has a kind of a sweet spot. We call that the sweet volatility regime. That's what I just made that up, by the way. But that's what I'm going to call it from now on, the sweet volatility regime. It's a volatility regime where you get what I consider the optimal opportunities, and both in ease of analysis of the market and also the amount of premium that you're afforded by that much volatility. Once you get beyond that or higher, things start getting a little chaotic. Below 17, I think it's even worse because things are anemic. It is difficult to grab a hold of anything. If you're familiar with signal-to-noise ratio, and you could probably, even if you're not someone into electronics or into radio or whatever, you could probably understand that trying to grab a signal with a radio or some other device really depends on how clear that signal is and how much or how little interference there is around it. The interference is referred to as noise, and the signal is the thing that you're trying to capture, like a radio broadcast or something. In this case, it's the market telling us what it's doing. And when a signal has very high amplitude, it's like this. It's very clear relative to the noise. Maybe the noise is only this big, but the signal is this big. It's very easy to discern that. It's like that in anything in the world. If you're, for instance, out and peering across a field and there's absolutely beautiful, clear conditions, you can see things for miles. If fog sets in, and that's the noise, or if there's a bunch of people running back and forth, you can't focus on something further down across that field. That's the noise. And so when volatility gets very low, the signal gets low. Now, the noise in the background, it doesn't even have to change. It can be the same level of noise. But when the signal comes down to the level of the noise, it becomes very difficult. I hope this is making sense. All right? The noise to signal ratio is very important. And when volatility gets down there, the noise in the market, and there is a lot of just random activity, just a lot of noise that is happening, really obfuscates the signal, and it makes it very difficult. Now, some people will look at something and second guess what you're doing and look at, I don't know, a indicator or a condition or a structure or whatever and say, well, it was obvious to me, Ernie, that it was going to go down. Or it's obvious to me, Ernie, that it was going to go up. And I have to nod my head to that person and say, great, all right, now, how often can you do that? Can you do that 1 out of 3 times? 1 out of 5? 1 out of 10? 1 out of 100? Which is it? Can you do it 9 out of 10? When you start getting to the point where you can do it 2 out of 3 times, then you have something. If you can't do it 1 out of 10, then what do you have? You really have nothing. The reason why I brought up that particular point was that there is a comment in our Discord that I wanted to read. I'm not going to mention the name of the person. It's irrelevant. And it was right to this point. And there's a few things that I wanted to talk about. It says, just a question. And I believe this is a new member, a trial. By the way, today's trade was a loser. It's about as clear as I can get. I thought that the market would go up, and it did overnight. And then when the market opened, it went straight down. And so we went from profitability to nothing. Fortunately, we put on asymmetric trades, and so the loss is very small. Anyways, back to this question. It's just a question, Ernie. In my opinion, volume profile indicated that price would pretty much follow the path that it took today, which was down. Now, first of all, I want to say something just so you understand about volume profile does not predict anything. It does not predict the where price is going or when it's going to go or anything like that. It is nothing more than a static structure that needs something to interact with it in order to then give it some predictability. By itself, it's impossible to predict where price is going to look or go when you're looking at volume profile. So just for that first point. So let me continue. In my opinion, volume profile indicated that price would pretty much follow the path that it took today, which was down. Foreign markets were up overnight, and I understand that our markets follow them a percentage of the time, but we were at record highs. All right, so as he said, we were in actual profitability overnight in what's called the Globex session. But the European session, Europe opens up before we do when you're coming off of a Sunday onto a Monday. And those markets were up. Now, we made our call before the European markets were up. Actually, when the Asian markets were open. And I guess the Asian markets were up as well. So, all good. But I'm not sure what that has to do with the market going down. Typically, we go with the trend. So if price is moving in a particular direction, especially over a number of consecutive days, then you would think that it's going to keep on going in that direction unless there's some kind of blockage or force getting in the way or a binary event that's going to prevent it from going there. Okay. So I'll continue on. I understand that our markets follow them a percentage of the time, but we're at record highs. Now, again, record highs. Does that mean that we should fade a high? Now, I'm not trying to be defensive here. I'm just trying to point out some things that are just facts in the market. When markets are at record highs, what is the better bet? Is it to fade that market or is it to go with the market on a record high? Now, a lot of people are in this contrarian camp and they want to fade everything. That means take the contrarian position and assume that markets are overbought and that they need to turn around and maybe get a breather and just take a rest, do a dip, and they keep on going. But the fact is that far more times the market moves in the upward direction when you hit all-time highs. So there's point number 3. Then he says, I don't know if it's a he or a she, by the way. I think everyone knew that the macro environment news for today was going to be close. Now, I don't know who knows that, which by my mind makes it neutral. So I think what he's referring to, or he or she is referring to, that we had the PMI and the ISM numbers, and they were mixed. One was up, one was down. One was bad, one was good. I guess you could say you could turn those and look at them together and say it was mixed, therefore it was neutral. But no one knew what those numbers were going to be prior to them coming out. In fact, the PMI and the ISM have been steadily going up, indicating that our markets are heating up, or maybe, or there's more activity, or there's more stimulus coming into the market, giving you this sort of false hope, but you don't know when that's going to stop. And you certainly don't know what that economic report's going to be prior to it coming out. Now, if you're going to take the whole kind of trend or momentum idea and looked at the ISM and the PMI, they have been going steadily up over the last 6-7 months. So why would now be the time where you consider it neutral or going down or be something different that would affect the market? So that's the next point. When you called the alert on this trade, the futures market was already up close to 20 points, and the expected move was somewhere around that. Now, because it was already up 20 points, and if the expected move was 20 points, are you saying then that, that means then that the expected move has shot its wad, right? That's all it's got in it. It went 20 points. No, that expected move is from the time, at that time, that current time, that present time that you look at the expected move, there is a 20 plus or minus direction that the market can go to. Once it moves up 20 points, then you take the expected move from that point as well. Well, it was still 20 points at that point, meaning that it could go up another 20 points or come down another 20 points. So when you move the expected move, that doesn't mean that you've used up all the gas. It simply means that the expected move was a good predictor of that move. But now that doesn't mean that it's all over. It could keep on going up. It could keep on going down. It could have gone up another 20 points or down another 20 points. You can't look at expected move that way. And I'm doing this because this person is asking, what am I missing? I'm trying to learn from this. So this is why I'm bringing all this up. And all right, the trade was requiring another 20 to 30 point move. I want to learn to follow your system, and maybe this is a timing thing, but I have not been able to enjoy the previous success, and am wondering, what am I missing? I think I just explained what you're missing. And this is why I talked about, I'm going to get to the Big Bang here in a second, all right? And why I talked about volatility. When you have very low volatility or shrinking volatility, combined with very low volume and liquidity, that produces a rather chaotic market, uncertain, frothy. If you've ever been to the beach and the waves are coming in and they get all frothy, at first the waves, if they're not frothy, they lift and bring you down. But once they get into that frothy, chaotic moment, you just sink. Right? In frothy environments, you really don't know what's going to happen. You could sink, you could rise, you don't know. It's going to be chaotic. I guess another analogy to this would be a water spigot on your house. Some of you may be familiar with that. And you may have noticed that when you turn on that water spigot, when you turn it on at first, at very low volume, it kind of sputters. It's chaotic. And then as you turn it, that stream starts coming out nice and smooth at some point. And it will stay nice and smooth as you increase the volume until you get to a point where you turn it so high that it is just flat out open. And then it starts getting sputtery again. That is a perfect analogy for volatility. Low volatility is chaotic and sputtering. Then there's a sweet spot. For us, that's between 17 and 34. And then once you get beyond that, it starts getting chaotic again. So we've been in this kind of low volatility situation, and our win rate has gone down dramatically. But it's not really a problem. And our win rate now has gone down to about 50%. So we win about 50% of our trades. We lose about 50% of our trades. And this has been over the past couple of weeks. And that is because of that signal to noise ratio, that frothiness, and all the things that go along with low volatility, anemic environments. However, because we're doing asymmetric trade, we can still win less than 50% of the time and still be wildly successful, which we have been. In fact, last week we won 2 out of 3. A week before that, we won 1 out of 3, and we're way up. Because the one where we won 1 out of 3, we returned something like 500 or 600%, or was that the 1100% trade? I can't remember, on the risk that we put on. The other 2 is just that 1x risk. Here we have 11x return, so you can just do the math. That's 1 out of 3, and still a wildly successful week. Last week we had smaller wins, but they were still in the 200 to 500% range. And so you're winning 2 times or 5 times the risk, and then the one trade where you lose is 1 times the risk. Again, a wildly successful week. So we can average around 50% and still do fantastic. So that's not the problem. Sometimes you might go into a week and you win and you lose all 3. Sometimes you can win all 3. When volatility is in that sweet spot, we were in maybe a record or something. I don't know. We won like dozens in a row, or only lost like a few over 35 trades. And that's when volatility was elevated. And it's because everything that I described before, volatility is so much easier to predict when, or movement of the markets is easier to predict in the short term when volatility is relatively high or in that sweet spot. All right, so now I'm going to get to the Big Bang. After I've gone all, I hope that answers the question of the person doing the trial and how I look at the markets and all those points. So the name of this episode is The Big Bang, and the Big Bang Theory is volatility back. And so what happened today? Now, first of all, what is the Big Bang? If you've taken any kind of science course or you've listened to any science lecture or you've read about the Big Bang or the different theories for the creation of the universe, I think the Big Bang for a lot of people has the most gravitas. It's the most popular theory about how our universe came to being, and that is in this one imperceptible moment when there was nothing. From that begat everything, a Big Bang. It just went from nothing, a singularity, to everything, and then it's been constantly expanding since then. And so there's this theory that when you have zero potential, you also simultaneously have infinite potential. And now, of course, we're not at those extremes in what I'm going to talk about in the market, but it's similar to that. So this morning, price came down from elevated levels from the European Open, and then the market opened, and price dropped down to a point, and then everything just went silent. On the S&P, we weren't moving more than within a 4-point range, which is virtually nothing. That's virtual silence. And it stayed like that for a while. And I said, this reminds me of the Big Bang Theory. I said, when you have a complete absence of volatility and volume and liquidity and a range that is almost imperceptible. Now, 4 points out of a 4,000 point index or a 4,400 point index. So that's 4 divided by 4,400. So that's less than 0.1%. Right? So the market was moving less than 0.1%. So I had said, look, it looks like we're going to experience what I call the Big Bang. Either we're going to move violently up or violently down. I don't know which, because it's chaotic. You really don't know. I would venture to guess that it was up only because that has been our momentum that way. And like you could take markets and you can sometimes think of them, these physical entities, and maybe they follow the same kind of laws of physics or fluid dynamics. As Newton might say that once an object is set in motion, it stays or remains in motion until some opposing force acts upon it. So the market was moving in one direction, so maybe it was going that. But maybe during that small period of time, because it was moving down, that was the direction. Who the hell knows? No one really knows. So in these times when volatility is like this and you don't have that good signal to noise ratio, you're really just guessing. So this is how we combat that. There are two ways. One is that we trade less or trade fewer times. When we are encountered, when we have that really poor signal to noise ratio and we can't really decide which way the market's going to go, maybe there are too many conflicting economic reports. Today, bad is good and good is bad, and maybe tomorrow is good and bad is bad. You've probably heard me talking about that in previous episodes. It's a peculiar thing that we have, or situation that we have in the market that the Fed has set up for us, where any kind of bad report is actually good, because that means the Fed may continue providing their very accommodative monetary policy. And everyone loves free money. So bad is good. But today we had two reports. One was good, one was bad. So what is it? Is it good or is it bad? I don't know. I really don't know. So getting back to how we treat markets like this, and these low volatility markets, we trade fewer times. And when we do put on trades, they are not as far out of the money or directional, and the spreads that we give them are much narrower. That keeps our cost way down and helps us maintain a kind of asymmetry that we're looking for. Now, when volatility is sweet and in that prime range that I was talking about, we can put on much wider spreads, which afford us much more premium, much more leverage, much more, I don't know how you put it, just more meat on the bone. And so we can trade more often, we can trade with bigger spreads, and we can be more generous with our capital because our wins are bigger and they're more often and they are more predictable. Now, I am glad that the market went down today because to me that puts us back into that sweet zone. Just barely, but it does put us back in there. We're now, I think the VIX now is up around, what is it, around 19? Let's take a look. Yeah, the VIX, the Volatility S&P index is at 19.38 right now. We started the day at about 17.9, so we're up almost a point and a half. And that was elevated from Friday because we had a little bit of roughness during the day on Friday. And just previous to that, we were down in the low 17s, and before that, down around 15, and that was just a horror show. When you get down there, it's very difficult to trade during those times. So people that are coming on the trial right now, I think you're getting a better lesson than those people that came on during times where everything was great. Some may argue that point. Where would you rather come in? Would you rather come in during the time when everything is sweet and honey is flowing and you feel like you can't do any wrong? Or would you rather come into the time where you have to take particular care in all your trades and try to really work that extra or go that extra distance to get the type of trades that you want? Now, I want to make it very clear that even though and I said this a little earlier, even though we have to drop down from, say, an 85 or a 90% win rate down to a 50% win rate, in no way does that not make us an ineffective strategy. As a matter of fact, our strategy now in this state, with the asymmetric positions that we put on, with the sizing, positioning, everything about it, I still believe is orders of magnitude than any other day trading strategy or any kind of swing trading strategy out there. We make more efficient use of our capital in our worst state by gobs, orders of magnitude, than any of these other strategies. And then when volatility is more in our favor, like it's getting now, I expect even better performance. So that's where we're at. Let's see, we have a few questions. Lance says, made 60% placing a butterfly trade with 20 wings using your principles, Ernie. Thank you. That's great. Awesome. Ken says, I can't think of any day where a trader wouldn't be willing to risk $100 for a chance of making five times the return. Sometimes as much as 10 or 20 times the return. But those are those nice volatility-laden regimes that we're in. Another comment, if, and I am, plus money in these bad times, I can't wait for the normal, much less great times. So yeah, that's the point. We've been doing relatively poorly compared to where we were, say, a month ago. We're doing fantastic. So I hate to sound glum. And we had a trade the other day where we only made 100%. Actually, most people made 70 or 80%. Most traders would give their right arm and their left leg to make 70 or 80%. That would be a very awkward trader, by the way. But that was our bad day. We all felt like ejected and let down and, couldn't you give us something a little bit more, Mr. Market? But yeah. That's where we were then. And today, we took a little bit of a risk. I think our trade was, what did we take? What was the size of our trade? I'll tell you in a second here. $75. We risked $75, and that was to potentially make about $400 or so, something like that. And that was a good trade. It was a good position to be in, and it was up actually in the early parts of the morning. If you were up that early, you could have taken some profit. And we were talking about how we were going to manage our profit in the morning should the market continue to move up for us. Unfortunately, at some point, it just decided to just dump. And which, for us, that's not a huge deal. When it dumps like that, we step back. Hey, can we make something out of this? Will there be another trade? Maybe we just wait around and it will turn around. Sometimes it does. And in fact, I think the market, is the market turning around? No, it's not. It's not. It's just keeping on going down. This is actually very good. I am very happy to see the market down like this because volatility is going up. 19.54 now. Hey, look, if we can break up into the 20 range, man, it's going to be sweet times again. The honey will be flowing. Let's see here. The main thing I find here is it's much easier to control my greed, a major benefit for me. Yeah, and that's because we don't have this huge bear or monkey on our back. I was going to say a bear, but there's no analogy there, is there? Or anyways, we don't have the monkey on our back because we're not taking huge amounts of risk. We take small risk for very large potential gains. We don't even have to pin our trades to make money. We can just be somewhere in the ballpark. And you're not sitting there sweating it out or trying to figure out whether or not you're losing out, suffering from FOMO. Let's see, another comment. I made the same 60% for these last 2 months. Not 60% of trades, but 60 cents of margin. And that's damn good, making 60% on your margin. Now, I would say that's actually, and that's average over the last month and a half or so. Prior to that, we were doing much better, way better. And that's when volatility, which, by the way, I should be celebrating because volatility now is coming back. Here's another question. Are there other strategies one could consider as a supplement to 0DTE? When I think of them, I will let you know. Our basic strategy with 0DTE, or 0 days to expiration on the S&P, futures on the S&P on the last day of expiration, is to develop a bias, a directional and magnitudinal bias. Which way is the market going and how fast is it going? Look at the market structure using volume profiles so that we can determine if the market goes that way and traverses that profile, that market structure, how is it likely to behave? And then put on an asymmetric trade somewhere on that profile that will give us the best combination of risk to reward and probability of profiting. So I found that the butterfly is really the best trade to do that. Some people might argue that, hey, you could probably do the same thing with a vertical spread. You probably could do something similar. But what you're going to miss on the vertical spread is that there's only one short contract for one long contract. When you're using a butterfly in that direction, you have one long contract with two short contracts, which are the short contracts are containing the premium, which is the potential gain. And so that's why we use the butterfly. And the butterfly, because you have another long contract on the other side, helping you manage the risk overall. So there are probably other trades that you could use that require a lot more account margin, like a ratio spread might do something very similar to the butterfly, and it might be a little bit easier to manage and would be something that might give you unlimited upside, but it would also perhaps give you significantly more downside too. So we can look at that. So a ratio spread might be one of them. There is a strategy called the Jade Lizard. I know that's just a crazy name, like iron condors and butterflies and all these other weird names. But it's another one of those strategies that's similar to a ratio spread that I think might be able to be applied to that. And we'll take a look at that as well. What's the official close for ES futures? For the futures, they actually close at 5 p.m. And there is a period where they are blacked out between 4:15 and 4:30, but then they reopen up until 5 p.m., and then they black out for an hour until 6 o'clock. And then 6 o'clock p.m. starts the new session for the following day. Now, options on futures, they close and expire at the exact same time that options on stocks do, and that's at 4 p.m. What did we learn today? We learned that analysis is quite a bit more complex than what we may first know, that markets tend to go or move in much the same way that you would have a model of fluid dynamics or just objects in motion. They tend to go in the same direction until some opposing force or event pushes them another way, or if there is virtually no event, no volatility, no anything, in other words, a complete absence of anything, and then you have that big bang effect, and then it can go in any direction. And that's what happened to us today. Yeah, that is what happened today, the big bang. And now, the cool part about that is we now have all this wonderful volatility. And volatility continues to rise. When I first mentioned it, it was at 19.38, then 19.5. Now it's at 19.88. So this is all good. Get up into the 20s, man. Come on, you can do it. All right. That's about all I have for today. Hopefully this was informative for you. If you please go and subscribe to this YouTube channel, subscribe to the podcast, and please give us a great review on that podcast. It would really help. I'd love that. I would be very appreciative. And if you'd like to try out our system of trading, our strategy for trading the last day of expiration of the S&P, then you can go to 0-dte.com/try, and you can try it up to 4 weeks. If you decide to come on, then I will rebate the cost of that 4 weeks for you off the price of the subscription. It's a great deal. We are primarily an educational, mentoring, and coaching force where you learn the strategy, and you'll learn it inside and out. And then we have alerts that demonstrate that strategy. So we've got a lot to offer, and at a great price. All right. Thank you very much. It's a good start to the week. Let's keep it going, man. All of you. Take care. That's the end. Uniformearth.com.